Good afternoon. Hi, this is Orest Tomaselli, President of Project Review at CondoTek. I'm joined today by Lisa Geloso, and Lisa's Director of Business Development and Project Operations here. We're here to bring you in a webinar on project lending compliance as it relates to Fannie Mae's new temporary guidance, and provide you with some best practices for lenders, based upon this new guidance that was issued in mid-October. Throughout this presentation, we're going to try and provide you with not only what the guidelines say, but how to really, drill down internally as a lender to do the appropriate review to establish warrantability. Within the process of this, we're going to outline very specific guidance for underwriters, processors, and sometimes originators that should be performed in order to make sure that this compliance happens. My name is Orest Tomaselli. Again, I'm the president of the Condominium Cooperative Review Division here. This is a recent change. For the last 13 years, I've been the owner of National Condo Advisors. And in October, National Condo Advisors was acquired by CondoTek. My entire staff from Condo Advisors that I had put together over 13 years, true experts in the industry in review. Some former agency employees came over and came along with me to work at CondoTek. I'll get into why I did that in a couple of minutes and outline some of the new products that we're offering into the industry. But before I do that, let me introduce Lisa Geloso. So Lisa and I have known each other for years in the industry and have, called each other for years to ask each other questions about, what our thoughts were about specific policies or projects. And Lisa, in her role here at CondoTek, in her role of, Director of Business Development and her product operations role, really is involved in almost everything. It's kind of funny. I talk to Lisa on a daily basis, multiple times a day. We talk about project guidelines, warrantability on a specific project, on whether or not a project is eligible for mortgage financing, on how to make that project eligible for mortgage financing, on how to help lenders essentially get through the process of warrantability or doc collection, and throughout the services that we provide here at CondoTek. So not only is she a very good friend of mine, she's kind of my business, or what do they call it, work wife, because I speak to her so often during the week. So welcome, Lisa. Lisa's going to help me out here today and provide some very specific guidance on, what a lender's perspective really should be when reviewing projects to these guidelines.
Thanks, Orest. Super excited that you and the former NCA associates decided to integrate into our CondoTek family. I think the timing couldn't have been more aligned for you to have joined us as Fannie Mae gets ready to roll with the new temporary condo and co-op guidelines. So I'm going to let you get to it.
Thank you. Yeah, we're really happy to, as you know. So CondoTek, is not a new firm in the industry. They've been around for, I think, a little bit over 10 years. And they've become very successful in providing their, condo pack product. And that product was essentially a full delivery of condominium documents for lenders to determine eligibility on projects. We've been working together for around 18 months and created an online portal for our lenders to utilize both of our services. We got together around 18 months ago and liked each other so much and knew each other in the industry, and thought that it was important for lenders to have the ability to do both condominium project or get condominium project warrants, as well as all the documents in one place. And through that journey of learning about each other and learning about each other's staff, we decided that it was a really good idea if we actually made it official. So again, as of October, we are now CondoTek. So there's a lot of new products that we're releasing into the industry. One that we're really proud of, which is called the Condo Project Warrant. which is a product which provides the ability for a lender to order everything at once, essentially order all the condominium documents and order the condominium project review, and to have CondoTek and its team warrant that condominium project review, warranted so far that if the repurchase happened on the property, on the project, that we would buy back that loan. So it's an interesting product. It's something that we haven't seen before in the industry. And by piggybacking on CondoTek's technology platform and their 35,000 reviews that they've performed in the last year, it's kind of a no-brainer as to for our lender clients, to be able to order this type of service in the industry. So that being said, boy, let's get to this Fannie Mae lender letter. This presentation will be available on our blog, and links will be active on that blog, so you'll be able to click through should you wish. I thought it was really important to have a link directly to the Fannie Mae guidelines so you can refer back to the lender letter. I know most of us on this webinar have already read this in one way, shape, or form or another and digested it, and everybody seems to have somewhat of a different opinion about what these guidelines mean. So this, the impact of these guidelines is going to be, far-reaching. We're going to see property management groups being impacted, of course, HOAs being impacted, lenders being impacted, originators being impacted, realtors being impacted, because all along this chain of real estate sales and lending, you're going to see these guidelines really change how condominium developments and cooperative developments are reviewed. The focus is actually, coming from a really good place. The tragic collapse of the condominium in Surfside, Florida, really changed the face of the lending world and the face of condominium ownership and lending. And I've said to my staff over and over that if we hadn't seen the video of that tower in Surfside collapsing, I think that a lot of these guidelines wouldn't have come out. But it was 2021, and we saw those tragic events unfold, and the devastating loss of life in that collapse. And frankly, a lot of these guidelines are important, and a lot of these guidelines, are set up in order to prevent tragedies like this in the future. So while I'm, cautiously stepping through these guidelines and looking at what it means for the industry, I think that the end result of paying more attention to what the agencies require us to pay attention to will inevitably be a good thing and may prevent a tragedy like this in the future. So lenders beware. These requirements are pretty heavy. Lenders are really tasked with making these determinations about project eligibility that they didn't really have to worry about before. It includes reviewing a lot of additional documentation, to do a lot of different searches, to an amped up appraisal outline by an appraiser that's going to have some sort of commentary about the structural elements of the project. A heightened review of special assessments, even though the guidelines for special assessment haven't really changed very much from Fannie Mae's previous condo guidelines and co-op guidelines. But there is certainly a heightened, review of those guidelines, a heightened review of those special assessments now required, and a complete review of whether or not the project has violations, that were issued by local or state regulatory agencies. This is a big change. I mean, we're seeing lenders really struggle with these new guidelines and struggle to determine, where they're going to end up as far as their compliance and operations teams are, within how to deal with these. So,
Orest, I think it's a really good point that we make to our lender partners here today, that the opportunity for them to ask some really pointed questions to the HOA so that they could be really prescriptive in requesting and obtaining any additional documentation that they may need. We are going to be reviewing a few of these examples and our best practices towards the end of the presentation.
Yeah, thanks, Lisa. I mean, there's a lot to go through. We're going to try and take you through it pretty quickly. Any questions that you do have about any of these guidelines or specific policy, Lisa and I and the rest of the team are available for you. We've spent the last month or so reviewing and re-reviewing these guidelines, looking into the, kind of crystal ball of what we think that Fannie Mae is really asking for, asking and polling some of the large national lenders in the industry about what, their thoughts are about these new guidelines, and how to really handle the requirements as outlined by Fannie Mae. So first things first, Fannie Mae has issued a new unavailable status for condominium and cooperative developments. It seems as if they've really had a list internally already of, which condominium and cooperative properties they did not want to lend in, because, within a week or two of those guidelines being issued, I think I looked at the CPM list and there were over 930 developments that had already been, listed as unavailable. So this isn't small. We think industry-wide, there's a lot of developments that are just going to remain ineligible. We think, of course, that the first place an originator and or a processor has to start, when a loan is originated, is to look at whether or not this unavailable status for a specific condominium project exists within CPM. We realize that not everybody has access to CPM, and as does Fannie Mae, and Fannie Mae is, within their guidelines, has a little section of how to get access for CPM or for a lender, and who to contact at Fannie Mae. So that is available within the guidelines and in the guideline link. But boy, we've talked about this internally over and over, and we actually think you should check twice. You should check, at the origination point and pre-closing to determine whether or not the unavailable status has been added to a specific development. Lisa, any commentary on this?
Yeah, so additionally, a best practice that I would do is probably shore up your eDoc repository with that search that you performed, that it wasn't unavailable. You do that at origination and you do it prior to closing, and that will help paper your file so that you have that available in case Fannie Mae wants to know.
I told you all that she knew her stuff. All right, so new construction condo reserve study acceptance suspense. This is actually a giant change. So for as long as I can remember, Fannie Mae would accept a reserve study and the prescription provided on that reserve study in lieu of having a condominium development, regardless of whether it's new construction or established or conversion. It would allow a development to have that prescribed reserve contribution amount listed in their operating budget in lieu of the 10% guideline. Fannie Mae has immediately suspended the process of allowing a new construction condo property to utilize reserve study. And it's interesting. Because what we've seen in the industry is that the reserve study is a great place to start a review. And Fannie Mae goes on in their guidelines to outline how important reserve studies are right now. And it's been an interesting place and kind of a conundrum for us because yes, we are charged with reviewing condominium and cooperative developments for compliance with agency lending guidelines, whether that's Fannie Mae or Freddie Mac or FHA or VA. But we're also charged with providing condominium compliance solutions for portfolio lending. So a lot of lenders come to us with their internal products and portfolio lending guidelines that they have and ask us to underwrite their individual projects that they're originating into those guidelines. I can tell you almost across the board, portfolio lenders are not only allowing reserve studies on new construction developments, but requiring them to establish the appropriate amount of reserve. So it's going to be interesting to see where this eventually falls because, new construction reserve studies have their place and serve a purpose. And I'm sure Fannie Mae's intention is to ensure that a development launches with this 10% line item in the operating budget. But I think a little bit more attention has to be paid to this guideline by the agency because what we've experienced in the industry is that developments that have this 10% line item on day one, as established by a developer, if you go back to that site 2 or 3 years later, that 10% line item in the operating budget is gone. Because on new construction properties, homeowners and boards don't think that it's as important to have that 10% reserve contribution, or more appropriately, that it's overkill. So we're going to see where the industry kind of, falls out on this and what future portfolio lenders and secondary market investors are going to say. But as of right now, for Fannie Mae, in these temporary guidelines, you can't utilize a reserve study for a new construction condo development, and you have to have a 10% line item for reserve in order to establish eligibility. Established and co-op reserve study acceptance is also in suspense. So there are tens of thousands of developments across the United States that utilize a reserve study to determine the appropriate amount of reserve to set aside based upon an engineering inspection of the property. Reserve studies have a really in-depth outline of structural and mechanical components, their condition and cost for replacement and maintenance over a 30-year horizon. So again, this guideline is interesting because we see many developments across the country that utilize a reserve study not to reduce their 10% line item, but to appropriately reserve so that, an abundance or an overfunding of the reserve doesn't occur. So there are developments out there that have $1 million, $2 million, $3 million in reserve accounts that won't have component repair or replacement costs for 10 or 15 years. And requiring them to add a 10% line item to their operating budget for reserve on those types of developments is certainly overkill. So I think Fannie thought about it a little bit and has outlined that it really shouldn't be a lender decision in the review of that reserve study, and is requiring those types of developments to be submitted through its PERS process for approval. That is industry changing. There are a lot of developments that are just going to not be Fannie Mae compliant. And other solutions are going to have to be put in place for lending in those types of developments if Fannie Mae keeps this guideline in place. So we'll see what happens in the future. I'm not entirely sure that this guideline is going to go away. I think that this guideline does do a good thing. It ensures that the mechanical and structural components of development get closer to funding than they may have been able to before based upon this increased contribution. But I'll tell you this, the developments that are in distress didn't have or don't have a reserve study. They didn't take the time and effort to order a reserve study to determine what the issues were on that development. So it almost feels like Fannie Mae is really requiring this of the wrong types of properties. However, we'll see how it plays out going forward.
So, Orest, let me ask you a question. We don't have our 10%, but we have a really expertise crew in place that has been used to looking at reserve studies. What would make a reserve study a good case to submit to PERS?
There are a lot of great reserve studies out there. What I typically look for in review of a reserve study is a couple of things. First of all, that the components have a that there is a detailed component list. That's not like buckets of categories like mechanicals, $200,000, or, exterior, $300,000. It really should have a very detailed outline of what all the components are within the development. But the reserve study is real, or can really be utilized to determine whether or not a development has structural issues, or whether a development has financial issues. Because within a reserve study, you're going to see what a starting balance is, how much cash they currently have in their reserve account. And it always struck me as funny that you could get a Fannie Mae full review without asking for a balance sheet, but you couldn't get an FHA loan without asking for a balance sheet and to determine how much cash a development had in their reserve account. So I think, Fannie Mae is really trying to figure out or find a way to get a report or get lenders to think about the structural elements of a condo or co-op property, and to make sure that these developments are really well funded, because I think they think that that's the reason why the condominium collapse in Surfside happened. And I tend to agree with them in many ways. I think that at Surfside, I don't think we would have seen that tragic event if the board and the homeowners actually spent the necessary dollars to get the appropriate studies, to get the appropriate inspections on their property, and most importantly, set aside enough cash for the repair and maintenance of the structural and mechanical components. So it's going to be
I think this is really where it's going to change the dynamic of how we're used to reviewing condos and co-ops.
Yeah, I think there are a lot of developments that are just no longer going to comply, and they may stay that way for a while. So look, the other shoe hasn't dropped. We haven't seen Freddie Mac's guidelines. We haven't seen FHA's guidelines. We have seen a lot of portfolio lending guidelines that aren't requiring this, or requiring a reserve study and allowing whatever prescription comes in based upon that reserve study. But we're waiting for a couple more shoes to drop in the industry here to see how I think this is really going to play out. Within this guidance, there is a really interesting section on special assessments. Fannie Mae's belief, based upon the guideline review that we performed, is that special assessments are indicative of some sort of problem within a development. That's not always the case. Sometimes developments fund repairs and maintenance through a special assessment, and only through a special assessment. Those developments aren't worse off or better off than others. They just fund through this special assessment process. So I'd argue that this special assessment requirement really should be, let's review the special assessment, and let's also ask them if they have a reserve study or engineering report, so we could determine what that special assessment is for. And there's almost an asterisk here. This is one of the issues that has come up recently that is really requiring lenders to really drill down and to make a determination on, how long the special assessment is for, what is it for, whether it's for a mechanical item within the development or a structural item within the development, and does it really relate to, deferred maintenance in the development. I think that if you see a development as a lender that has a special assessment, it is absolutely not an automatic write-off and an automatic no. You'd be saying no sometimes to 70 to 80% of the condominiums that exist out there. But I think you do need to do your due diligence to figure out what it's for, whether the repair has been performed already, whether it does impact the habitability and structural integrity or safety or soundness of the development, and whether or not the homeowners, can, handle that special assessment fiscally. In some cases, your answer is going to be a no-brainer. Yes, special assessment is how this development has funded their repairs for years. And in some cases, you're going to have to say no to lending in these developments. What do you think, Lisa?
So I think lenders need to make sure that they're being very thorough and prescriptive here, and that they're asking for reasons for the special assessment, like you said, to piggyback on what you said, what they're related to, what impact they have to health and safety, what's the dollar amount, what's the repayment schedule. None of this is very different from how you would look at special assessments in the past. It's just being a little bit more thorough and more prescriptive, and making sure you get those answers to make your determination on what the special assessment is for.
Yeah, agreed. It's funny though. You're right. This isn't very different from what we've all reviewed when reviewing, all looked at when reviewing special assessments in the past, right? But it's interesting that they really highlighted it within these guidelines. I think lenders really have to, take another look here and make sure they're doing the appropriate review on these things. There is a whole new section for appraisers that has been outlined by Fannie Mae, and appraiser requirements, when doing appraisals on condominium units within condo, or, condominium or cooperative units within these developments. It's interesting. Not all appraisers are, equal. A lot of appraisers have some appraisers have a lot of experience in structural deficiency, deferred maintenance, what a problem with a condominium development is and how to identify it. And some appraisers have no experience with that. So it's going to be interesting to see how this plays out, because lenders are now required to go back to the appraisal and ensure that the appraiser has commented on the structural integrity of the property in some way, shape, or form, which frankly, I'm not sure a lot of appraisers are going to feel really comfortable in doing and signing off on this, especially if they don't have the expertise to do it. So I would say to tread very cautiously here, to, as a lender, to really ensure that your appraisers and your appraisal teams are appraising these properties and opining on the structural components and or mechanical components within their reports, as outlined by Fannie Mae within these new guidelines for appraisers. What about you, Lisa? It's kind of an issue, right?
Yeah, it definitely is an issue, and a good best practice here. And what I've seen on a lot of GSE audits is mismatched information, meaning that you have information that comes in through an HOA questionnaire or by a letter of explanation or by any other means, and it doesn't quite jive up with what's on the appraisal. So my highlight here would be to make sure that your appraisal info aligns with any supporting HOA or project information that you have. You'll save yourself a lot of heartache if you take that extra step to make sure that it's really cohesive information.
And it's also now one of the kind of best practices, which we'll list a little bit later on, having lenders really go back into their appraisals and ensuring that, as you've outlined, everything matches. But, making sure that that there is some sort of commentary from an appraiser on the condition of the property.
Yeah, and Fannie Mae is definitely highlighting that they want this information to be shared. Whatever tools, whatever information you have, the information should be shared and aligned, meaning that if you have your HOA questionnaire, you could send it off to your appraiser to make sure that they're on the same page and they're pulling the same information.
Yeah. Here's a big one. So, you know, I operated on the lender side earlier in my career, and I never knew what a PW was. I mean, it's going back a long time. I don't even know if PWs existed back then. And after I opened National Condo Advisors, I started working with a bunch of large national lenders. And I found out that, you know, there are some national lenders that submit hundreds of project eligibility waivers, or had submitted hundreds of project eligibility waivers on a monthly basis. You know, there were all sorts of reasons why you could send a PEW to Fannie Mae. You know, whether there was, if there were a couple dollars off on their 10% reserve line item requirement, if there was some sort of, you know, issue with the borrower, or project, you could, you know, ship off this project review and included with the borrower review over to Fannie Mae, and you'd get a sign off in many cases if you could prove your you know, point of view and point in you know, reasoning for wanting to lend to that specific borrower. A lot of that's going away, right? So, you know, it's no longer an accepted vehicle for lenders to determine eligibility. It's not going to be issued for significant deferred maintenance, certificates of occupancy, regulatory inspections, projects with large special assessments, and or any insurance policy deficiencies. That's a big change. So I think that the PEWs are going to be, you know, fewer and fewer and fewer, because I think you're going to be able to get fewer and fewer and fewer through. Any thoughts on this, Lisa?
Yeah, I mean, I think you summed it up. You summed it up perfectly. And the cool thing about Fannie Mae is they do analyze their PEWs to collectively see what the industry is asking for, and based on that, I have seen them change their guidelines. I don't think they're going to change their guidelines with respect to the deferred maintenance and the CO and the regulatory inspections, but they do look at them to get collective information from the field.
Yeah. So what are we all looking for, right? I mean, what the spirit of these guidelines and kind of the crux of these temporary guidelines is to ensure that these developments are habitable and free of unsafe conditions. Fannie Mae seems to believe that, you know, if that project suffers for some sort of deferred maintenance, that project should be ineligible because the work hasn't been performed and it could cause major issues. Now, while I'm sure that's true, and I'm sure that there is a probably good percentage of developments across the United States that, you know, have not done the work that they were supposed to do. I think by and large, I think homeowners are, you know, kind of thoughtful about this. However, you know, as clearly outlined here, you know, determining this eligibility criteria is going to require a lot of things, which could include a violation search, or, you know, a detailed review of the special assessments, and to see what deferred maintenance really means in every single site. Because you may get a questionnaire that comes back and says that there is deferred maintenance, and it may be for, you know, the bench in front of the building that, you know, somebody cracked. Is that a reason to make an entire project ineligible? I don't think so, as long as they're going to replace it or fixing it, right? But, you know, they may not have been able to replace it during the dead of winter, and they may have had to wait till the middle of summer to replace that bench, or at least springtime in some municipalities or areas across the country. Would you still lend in that building if every other part of that building was compliant? So if there is a regulatory agency that has issued some sort of you know, inspection driven you know, repair order based upon unsafe conditions, those projects are not eligible for purchase. Well, of course they're not. I mean, you wouldn't want those projects anyway. You're going to, you know, those developments are going to have to do the work. So I think that's a good guideline. It's not a bad guideline, for obvious reasons. And I think this is one of the, you know, kind of bullets in Fannie Mae's gun to kind of ensure that they're getting quality loans in quality developments. The definition of it, though, is going to be interesting to see how, what Fannie Mae really thinks deferred maintenance is. And, the policies outlined there, they don't really pertain to, routine maintenance or repairs that a homeowners association is making. So, I don't know how to, advise everybody yet. It's an interesting place to be because, what's the difference between routine maintenance, and yes, Fannie Mae outlines it within their guidelines, but some of those routine maintenance items may be for mechanical systems. So I'm not entirely sure. And I think that the way for a lender to really make sure that they're doing their right job is to look at a lot of the different documents to determine if there is, significant deferred maintenance. And that's why a little further on, we're going to talk about best practices and what Fannie Mae is requiring in best practices. But it's going to flesh out, I think, in the future. We're going to see maybe some more direct guidance here on what is really considered deferred maintenance and what is normal maintenance. Lisa, any thoughts here?
Yeah, so before we go on to the next slide, maybe you could just recap for us. Give us an example of deferred maintenance, one example of like an ordinary deferred maintenance, and one example of what, in your opinion, would be significant deferred maintenance.
Sure. So we had a project recently that had a repair to its entire HVAC system that was listed within its questionnaire. And when we spoke to the homeowners association, the property management firm, and this is a week ago, this HVAC repair was to the air conditioning unit within the development. The project is located in the East Coast of the country. They stopped using air conditioning there around September. And they do these repairs during the winter months to ensure that, the system is functioning appropriately in the summer when it's needed. Is that considered deferred maintenance? We didn't think so. We thought that was like kind of a normal, course of action, and it wasn't because of some sort of neglect to the component. So that would be an example of a project which seemed like it had deferred maintenance, but really didn't. We had another development that had part of its balconies that were essentially coming loose and cracking. And even though it had only occurred in 2 or 3 balconies, it was definitely an issue that it seemed like the whole entire development was going to, have to deal with at some point in time in the future. But the board hadn't done anything about it. There was a fight between the board and the unit owners on who was responsible for it. And the condominium documents clearly outlined that it was a board cost and it was not the homeowner's cost, but the board still was fighting it. Look, that's a deferred maintenance item that could kill somebody. Yeah. And a piece of falling concrete, a screw that falls from the 30th story could kill somebody. So that would be an example of very significant deferred maintenance that it would be a project that we would reject here should it come in under a condo project warrant request, because we just really want to make sure that these buildings are safe. So best practices. Well, there's a whole section on best practices in these Fannie Mae new guidelines. Some of these guidelines, and I think let's step back for a second. I think the intent here is really good. If you look at the guidelines as a whole, what Fannie Mae is trying to do is really determine if there's deferred maintenance that's going to cause a habitability, event in the future, that, to determine whether or not the structural integrity of the building, is compliant, and, these buildings don't require major structural changes, or the structure isn't falling down. And to ensure that the safety of the homeowners and the people walking by the building is maintained, right? They want to make sure that those buildings are habitable, and that deferred maintenance isn't going to cause them to be inhabitable. inhabitable. Sorry. So it's an interesting, section of these guidelines, because one of the things that Fannie Mae asks, and we get this question from every single lender we work with, is, and it's outlined very clearly, as a best practice, the lender should review the past 6 months of a project HOA meeting minutes and determine from those meeting minutes if any discussion was had about maintenance or construction that may have significant safety, soundness, structural integrity, or habitability impacts. So what's interesting about that? What's interesting about that is, first of all, not every condominium HOA scribes minutes. We have developments that haven't met in 2 years and don't have any HOA meeting minutes. In many instances, the individual who is the scribe and writing down the meeting minutes in the developments that do keep meeting minutes, you can't read their handwriting, or it hasn't been transposed. Sometimes it's, not to be ageist, but this is what I've seen in many developments. It's the 82-year-old, homeowner in the corner that's, writing down, what's being said at these meetings. I walked into one association discussing, issues with their structure, and I was with the property manager, and the property manager took out a notebook, and around 30 pieces of paper fell out of the notebook, and it was her notes on the meetings over the last 3 years. The point being, it's going to be incredibly difficult to get meeting minutes, if you can get them at all. There's a discussion about privacy on whether or not a property management group would even release the meeting minutes, or a board release the meeting minutes. Attorneys across the country are opining about this, saying that it would and could open up associations to litigation should they release these meeting minutes. So I think we're going to see major pushback here. But let's look back at what the spirit of the requirement is. The spirit of the requirement is, we need to know whether or not there's a structural issue in the development. And we need to know if there's deferred maintenance there. So there are lots of other clues, lots of other red flags that you review on a daily basis when you're reviewing a condominium project. You have the appraisal to look at. You have the title to look at. You get to do a violation search within that title to see if there are any violations issued to the property, the whole history of violations that have been issued to that property in most circumstances. In some instances, you have a reserve study. In some instances, that reserve study is even, was performed within the last 3 years, as is Fannie Mae's guideline for reserve studies. Sometimes you have an engineer inspection. So the point being here is, I think in a lot of cases, you're asking for most of the documents, which would lead you to believe that that development is an issue development, or a development that really looks like it's clean and clear based upon all those other pieces of information. I think that's the point here. You're going to try and get everything you can to make that determination. And if you've got nothing else, go into the meeting minutes. Let's see what they talked about. That being said, we did get our first PERS review back this week on a project that was submitted to PERS prior to the guidelines taking effect, and was issued a conditional approval after the guidelines took effect. And one of the conditions on there is Fannie Mae wants to see the meeting minutes, which, by the way, don't exist because the board hasn't met for 9 months. So, the response back to Fannie Mae is, we've provided you with the reserve study, with all the other appropriate documentation to determine that this project has no issues with, their structure or deferred maintenance. Please make a decision based upon that. Looking for those inspection, engineering, certification reports, that have been completed within the 5 years is one of the other best practices. Again, I've kind of outlined that, but you got to start asking for this stuff as a lender. I'm not entirely sure how much of it you're going to get. We do a very good job at CondoTek of collecting documents. for lender review. And in some cases, this is very difficult for us to get. But again, we're at the infancy of these guidelines, and I think that the industry is just starting to come around. Like, as an example, we're seeing a lot of questionnaires be changed in the industry to ask these questions about habitability, structural integrity, soundness, safety, deferred maintenance, asking questions like, in the last 6 months, have any of the meeting minutes indicated that there's a structural problem within the development? I mean, we've changed our internal questionnaires to ask that same question here at CondoTek. And we think that we could build a strong enough case and warrant enough sites that are good sites, by asking the right questions. And look, far be it for me to say that there are developments out there that, don't have issues. I mean, I would guess in the thousands of reviews that we've performed over the last, 13, 14 years as a conglomeration of CondoTek and my former firm, National Condo Advisors, I would say probably 5 to 7% of the developments that I've ever reviewed had a red flag that would indicate some sort of structural issue. And it may even be fewer. However, it only takes one, right? We want to prevent this tragedy in the future, or the tragedy that occurred at the Surfside in the future. So from that perspective, I get it. Again, Fannie Mae within their best practice section also outlines that, they're reminding lenders that the appraisers must document any special assessments or deferred maintenance, right? Because a lot of people have been asking, well, how are you going to get this information? Well, the appraiser is going to give it to you. The title report's going to give it to you. Again, there are lots of documents that we review on a regular basis that leave clues. It is interesting, though, that this outline was listed within a best practice section and not the guideline section. It's one of those questions that comes up and makes me think a little bit. Is this really a guideline, or is it really a best practice? Because if you look at it, it says, it may be appropriate for lenders to take, to review and to take, to determine eligibility. I'm not entirely sure. I mean, based upon that statement, I think that this isn't really a guideline and that it's, again, a best practice. Not a bad idea, but not able to be obtained in many instances. Lisa, any thoughts here?
Yeah, I think we as processors and underwriters and certainly project review managers, I think our first inclination was like, oh my God, I have to get the meeting minutes. And I want to just specifically highlight this to piggyback on what you said, that they may not be available, and in most cases they won't. So as a project review underwriter or someone managing a condo review department, you have to be able to find the breadcrumbs, to find the clues, to extract exactly what Fannie's looking for. Has anything been discussed in reference to improvements, renovations, inadequate reserve funding, deficits, negative cash flow? The crumbs will be there through budget, maybe even through balance sheet. So probably won't get the HOA minutes. If they're there, great. It should be a fun read. But if they're not, there are definitely clues and breadcrumbs that you could extract by asking your pointed prescriptive questions to the HOA, and then kind of putting together your story to tell it based on that.
I've read some meeting minutes, and there's a lot of talk about dog waste in elevators and loud noise in buildings. I have not seen a lot of meeting minutes with anything that references structural issues within the developments, just as an aside. So there is a section here we're going to outline at the end, which is, what we think and, recommendations at CondoTek that we want to provide to you. But first, I just wanted to outline some of the things that we're doing in the industry that are really different, and it may help you get through some of these guidelines should you wish. CondoTek has a full suite of lender compliance services, right? Now with the acquisition of National Condo Advisors, the CondoTek staff is full of really smart, knowledgeable, incredibly brilliant, in fact, reviewers for both, for Fannie Mae, Freddie Mac, FHA, VA, and portfolio lending. So we're so happy to be over here and, to be able to provide the services to the CondoTek clients and to our clients that we've had for years and years and years. So everybody knows the Condo Pack service, which is, of course, the delivery of all the condominium documents. What we're releasing this year, and just about to release some of these projects, some of these services for our projects and for our lenders. We're releasing the Co-op Pack shortly, which is providing all the co-op required documents in the industry. And we've already begun to beta test and release, slowly, our condo project warrant services, which really is the ultimate review solution for our lenders. That combines not only the Condo Pack documents, but also the lender review. And we're offering that at a standardized rate, flat rate of $595. So that's important to outline. And I did not want to make this commercial, but I did want to outline what the services are and what we were talking about in the industry to our lender clients and how to address a lot of these guidelines. So close to finally, what are our lender recommendations? Look, we have been back and forth through these guidelines, feels like 100 times already. We really think that originators, or at the very beginning of the origination process, that projects need to, eligibility needs to be determined. Is it on that unavailable list? We also think that's probably a belt and suspenders thing to do, to double check that that project is still available prior to closing the loan there. Reviewing all appropriate documentation for those red flags, right? For those crumbs that Lisa mentioned earlier. Look at the questionnaire really closely. Look at the questions on the questionnaire. Do they reference any issues regarding the HOA meeting minutes? Do they reference any issue regarding structure and deferred maintenance? The budget. Lisa, you want to opine here for a second? The budget to title the violation searches. I mean, you're really finding a lot of clues there, right?
Oh, yeah, for sure. You will find it through your special assessments. You'll find it through elevated insurance deductibles. There's so many ways that you can uncover what you're looking for by really thoroughly looking through all the documentation that you'll request for your project.
Documentation that I guess has been around forever. I don't know if this level of review has ever been done on it before, but it's going to have to be done now.
Well, yeah, that's the point. You need to heighten that review. You need to understand the red flags that you need to look for, and then, do a little detective work on those red flags to make sure that it's not uncovering a bigger problem. So documentation that we're used to looking at, but now we have to look at it with a laser focus.
Yeah. Number 3, look, one of the things that we've seen a bunch of lenders fail at is aligning their sales, their processing, their underwriting, and their project approval teams if they do it internally. In this new Fannie Mae policy, and really establishing consistency in underwriting policy. I mean, we've seen, and Lisa can attest to this and outline this. I mean, one underwriter will underwrite a project one way, and one underwriter will underwrite a project a different way. And, in some instances, both of them are wrong. It's really important to align the teams. Number 4 is, of course, look out for what the other agency guidelines that are coming. We know that Freddie Mac is going to be issuing guidelines shortly regarding Fannie Mae's guidelines, or essentially regarding in dealing with the tragic events at Surfside. We're not sure what those guidelines are going to say. I mean, traditionally, Freddie Mac has been much more accepting of reserves, reserve studies, utilizing other sources of capital for reserves in certain marketplaces like New York, where they'll allow the working capital account to be utilized for reserves. But there's going to be a lot of new guidelines coming out. And I mean, really keeping your finger on the pulse is important. I mean, I'll tell you this, what we're going to do here, we've already got 2 other presentations that we're doing, one for property managers and one specifically for HOAs to outline how these guidelines impact them. I will tell you that future presentations will be coming based upon Freddie Mac's policy when it's released, FHA's policy when it's released, and how that's going to impact our lender clients and the other segments of the industry. So look out for all of those on our blog, and they'll be announced as these guidelines are released. Number 5, gosh, the reserve study is the greatest way to determine whether or not there's structural issues or deferred maintenance on a project. I would say that whenever you can, and one of the policies here at CondoTek when we're performing a condo project warrant or a condo pack is to request that reserve study regardless of these new guidelines that have been released, right? So in the cases where we can deliver a reserve study that's been performed on a condominium development, we're going to. And we think that it's a great tool to determine structural issues and or deferred maintenance in a development. So the point is, ask for them. Ask if one has been performed. Ask if one has been performed in the last 36 months. Get it whenever you can. And finally, number 6, really to look at your condo and co-op questionnaires. You're going to have to amend them to align with these agency guidelines. And you're really going to have to include specific attestation language for HOAs and property managers to attest to the fact that these developments are indeed compliant and don't have deferred maintenance and or structural issues. Look, it's one of the steps. It's one of the cogs in the wheel of compliance. You just got to make sure it's there. So Lisa, is there anything else that I missed that you think is important for a lender to know?
Now, I think you did a brilliant job, and I love that we're talking about this. I love that there's finally a forum and a place to demystify some of the condo and co-op conversations, long overdue. So thank you. Thank you very much, Orest.
Oh, you're welcome. Thank you. So if you need to schedule a demo on our CPW condo project warrant product or on the condo pack or co-op pack as it's released into the industry, please contact Lisa or I. Again, this presentation will be on CondoTek's blog. So that'll be posted there shortly if it isn't already. We'd like you to really ask us any questions you have about the guidelines. If you'd like to schedule a demo of the new technology we've released into the marketplace within this CondoTek CPW product, please call upon us to do that. I am absolutely blown away by the tech that exists here and the accuracy of the information that's provided to our lender clients. So I'm really happy I came aboard because it's really the future of condominium compliance for a lot of the lenders in the industry. And I bid you all adieu. Thank you so much for spending this time with us today. Again, if you have any additional questions, please ask. Happy to answer them as soon as we possibly can. Thank you so much.
Thanks, everyone.